to introduce Ernie Goss, here to kind of give us some insight on economic outlooks in the future. Ernie is the Jack McAllister Chair in Economics at Creighton University. He's also principal of the Goss Institute in Denver, Colorado. Dr. Goss is a U.S. military veteran, a former faculty research fellow at NASA's Marshall Space Flight Center, and he was a visiting scholar with the Congressional Budget Office. He has published more than 100 research studies focusing primarily on economic forecasting and on the statistical analysis of business and economic data. His book, Changing Attitudes Toward Economic Reform During the Yellstein Era, was published by Prager Press, and his book, Governing Fortune Casino Gambling in America, was published by the University of Michigan Press. He is editor of Economic Trends, an economic newsletter published monthly for more than 10,000 subscribers, produces a monthly business conditions index for the 9-state Mid-American region, and conducts a survey of bank CEOs in the 10 U.S. states. It is my pleasure to welcome Ernie, and we can all give him a warm welcome.
Thank you, Jacob, and thanks to all of you, and certainly thanks to Blake Goss, my long-lost child. No, kidding. It's just, don't run into many Gosses in this part of the country, so, and I understand he's from Texas also, so I grew up in Georgia. But anyway, thank you for having me. Thanks to the Chamber of Commerce, Central Chamber of Commerce, and Blake Goss and Jacob and his bank. So I'll talk today, and I apologize for this presentation. It's sorry. It gets a bit dated. I put it together last night. I mean things in your industry, those who are in ag, many and maybe most of you are in ag, every day can change. I mean, and as you know, the president, whether you like him or dislike him, he talks a good bit, you know. And when he talks, markets move. And so anything I may say about ag and ag outlook and so on, could be offset tomorrow morning by something that's stated by the president. So take that with you if you would, please. But nonetheless, that doesn't mean I'm negative about what's going on in ag, but you know what's going on. And by the way, that's the survey. See the survey region we have. We surveyed that region, 10 states. We surveyed manufacturers and agriculture, bankers who are in rural areas of 10 states, and they're going to tell us, they tell us, and we tell others about what's going on in ag. Now you may say, well, what do bankers know about what's going on in ag? They know more than I do, that's for sure. And so it's good to be with you, and I'll talk about that. And I have to say, the perils of a debtor nation, economic outlook, and risk factors. Now you, more than, and we also do a survey of manufacturing. Ag and manufacturing, the two industries, two sectors in America that are most affected today by what's going on internationally. We're talking about tariffs, of course. And the president, and I'm a fan of the president's, but I'm not when it comes to tariffs. He says it's a beautiful word for economists. It's an ugly word. We know, unless, of course, if he's negotiating. And I don't know. Only Melania doesn't know. And who knows what is he really negotiating? Is he going to get something better? And we have to say, when he makes some of the statements, well, if they'll bring their tariffs down, we'll bring ours down. That makes sense to me. But what if we all increase them? Do we really want to grow hothouse Iowa bananas? No. So we want to raise corn and soybean and effectively trade for Guatemala, or Honduras, Guatemala, and bananas. But anyway, and I want to thank my colleague here, Monique Devilliers, who's on your cell phone there, I guess. Check.
For you when you ask me, so I'll have the answers.
That's right. She's going to ask me some softball questions, so thank you.
I try to find one so he doesn't know the answer.
Okay, but I think importantly, and you know it better than, obviously better than I, about risk factors, and it's probabilities. and probability. We deal in probabilities. That's what economists talk about. I mean, we deal in, find me an economist that buys a lottery ticket. Okay. Find me an economist if you find an economist in a casino, that economist is lost. Because we don't know a lot about a lot of things, but we know a little bit about probabilities. I'll tell you a little story about probabilities. As Jacob said, I'm a military veteran. And when I flew on, I don't know if you know the P-3A Orion. It's a submarine hunter, and I flew on that P-3A Orion a long time ago, as you can imagine. And the Navy sent me to Norfolk to go through aircrew training school, the first section, then you go on to other places, of course. Anyway, I got into get the train to Norfolk, and then went on to stopped in Portsmouth. And Portsmouth and Norfolk are separated by a tunnel. And it's not like when I teaching college, when you show up late, excuse late, I like this. You show up 15 minutes, better. 30 minutes, even better. Don't show up at all, that's fantastic, until, of course, later on, when they've got to get a job, then they are angry about it. But then, anyway, they're happy about it. But anyway, I'm sweating bullets because I got to get the heck over there, because in the Navy it's called AWOL. And I got to get over there. So I'm in a Burger King, the guy sees me there, he said, son, I'll take you over there. So I get in his car, we're going underneath the tunnel from Portsmouth toward Norfolk, and I mean, wise guy, I turned to him and I said, how do you know I'm not a serial killer? And he says, you know what the probabilities are of 2 serial killers being in this car? That's probabilities. In other words, you got to know your probabilities. And everything is, but then people take our forecast, you put 100% or 0% probability on it. It's not either one of those usually, somewhere in between. So anything I say today it has a probability distribution associated with it. But I'm going to talk about detonation, economic outlook, and risk factors. So my first slide, I know you're going to have a hard time seeing that, but it's talking about tariffs, risk factors. Anyone, you don't need an economist to tell you. I would say right now, that's the #1 risk factor for all of us, not just agriculture, but especially agriculture, not just manufacturing, but especially manufacturing. And we've got to understand how it upsets the apple cart, how it can. And here's another little secret that the president obviously knows. If you raise the tariffs on China, they can offset it with a 10% devaluation of their currency, the yuan. You can do that. You say, well, why doesn't the president do that? Our president doesn't control the value of the dollar. Xi Jinping, the head of China's Communist Party, does control the value of the yuan. So he can devalue it, and all of a sudden you're back to square one. Now that would be very popular with the president, our president, but that certainly can be done. So devaluation, what's going on right now, as you know well, we've got a very strong dollar, and that's really hurting ag. We don't hear much discussion of it, but obviously, I'll get to why the dollar is so strong right now, and will it continue to be strong? But that's a risk factor, is tariffs. I'm sorry, you probably can't read that. And by the way, many of you may remember Alan Greenspan, the head of our central bank, Federal Reserve. He was testifying before Congress. He said, to testify, he says, Madam, sir, madam, if you understood what I just said, I misspoke. I mean, and I'll tell you today, if you don't understand what I'm talking about, I'm misspeaking. I mean, we economists should talk in the language that everybody understands, because it's, at the bottom line, it's pretty darn simple. Now, we put it in these models, and it doesn't get very simple. In fact, it gets so complex that we don't even understand it. So that's what we're talking about. But the current debt and interest payments now have moved above what we're paying for military spending. Think about that. In other words, and you look at it and you think, why did Jay Powell, the Federal Reserve, last fall, reduced interest rates by 50 basis points, and another 25 basis points, another 25 basis points. Why did he do that? Well, one of the reasons is, I think, to get Kamala Harris elected. Of course, that, you can see how that worked. And then the other reason is to reduce the burden on the federal debt. Okay, so that's one of the reasons. And the question is, will he continue to do that? And I'll talk about that later on, but the problem is, we have a wartime deficit and a peacetime coming. And what happened in agriculture, some of you, I'm sure many of you were there in 2018 when the president put on those tariffs then. The difference this time is there are no funds there to assist the pain that agriculture experiences this time. In other words, we've got a deficit of $2 to $3 trillion. We've got a debt approaching $37 trillion. Where's the money going to come from? And the answer is it's not there. It is not there. Now, they will find it. Where do they find it? It's called, now this is a fancy word, we have monetized debt. What does it mean? They do helicopter bend, it was called at one time, spray the countryside with dollars. And how's that done? The Federal Reserve. The Federal Reserve buys the debt that you and I do not want. And that's been done, will be done, can be done, will continue to be done to some degree. But there's a limit. Here's another one. Look at the U.S. stock market, the risk factors. It's at all-time, what is going on in two markets, the stock market and the bond market for that matter, and the housing market. Housing, you think it can't go any higher, and it does. I mean, what happened? I mean, this is remarkable. The CPI came out last week, and it showed too much inflation. Too much inflation. And what happened? Markets took a dive that day. What happened the next day? Up. I mean, we're back. I grew up in Georgia. We call that whistling past the graveyard. In other words, all the bad information is ignored. All the good information is processed. And we are whistling past the graveyard. And I know Moni says, don't depress everybody. Well, that's what we economists, we're here. Blake has said, be a little more positive, would you? Well, that's not our cup of tea. We take the punch bowl away when the party gets going. The economist takes the punch bowl away. That's what we do. But look at that. The Buffett indicators at a maximum. But what's driving this? What's driving the stock market? Why on earth is it heading higher? It's unexplainable unless you look down beneath it. It's ETFs. You have ETFs, exchange traded funds. I have ETFs. They just go in there regardless. Every month, Creighton University sends money to Tia Kreff, our principal, in my case. They buy ETFs. Doesn't matter what the market is doing. And I've tried to get hold of it, and they won't let me get control of it. They say, well, man, you don't know enough about this. And I mean, and I argue with them. I'm saying, in other words, David, you're protecting me from myself. That's true, yes. That's what we're talking about, those ETFs. And then when everything goes well until they don't go well. So when those things go down, you could have what's called a correction. Or a bear market, even worse. But nonetheless, another reason. Now, this is, when you buy, we have a law in economics, it's called the law of supply and demand. It's not called a good idea, we call it a law. When something goes down in price, you buy more of it. So what's the idea of this? Apple stock price goes up, they buy more of it. More expensive, they buy more. Makes no sense. Makes no sense. But that's what's going on. Those stock buybacks, they're called. I mean, why? It's the most maddening thing for an economist to see stock buybacks. And what's happening, and this is again long term, they're exchanging debt for equity. By that I mean they borrow money in the debt market, they take the cash and buy back their stock. Well, you see the risk right there. The risk, we're getting too much debt out there in the corporate sector. Now, I'm not talking about the Magnificent Seven. I'm talking about the market in general. But the Magnificent Seven as well. That's stock buybacks. FOMO. Fear of missing out. That is driving us all. And I have to say, I'm a victim of it just like everyone else is. I see it. I got to get that NVIDIA. And that before I thought NVIDIA started with an I, but it doesn't. You know, that's NVIDIE. Well, you see what happened to NVIDIA. It took a hit because of the Chinese company that's competing with them. So, in other words, again, it's FOMO. Now, right now, gold prices higher, higher, higher. And I have to say, I own gold. Now, I don't buy gold directly. I buy GLD, an ETF, exchange traded fund, ETF, exchange gold prices. What about Bitcoin? What about that? Again, FOMO. You see it being driven higher there. So the Buffett indicators, P ratio, which you're probably more familiar with, MMT, modern monetary theory. That's the craziest thing. It is not a theory. It's a political statement. And you know who might be head of that, AOC. You've heard the name, Alexandria AOC. You know, money could tell me who that is, Cortez. But anyway, it's what it says. And she says it can go on forever. Well, it can't. I'm not judging. And it can't. When will it stop? It stops when it can't go any more. And something, Herb Stein, the reason I got that name up there, Herb Stein, he's the chief economic advisor to Nixon. He said, if something can't go on forever, it will stop. That's pretty good advice right there. And it's pretty correct. This market cannot keep it going, and the MMT can't go on. In other words, the Fed cannot keep buying bonds, enlarging their balance sheet, and creating more debt for the federal government that must be paid interest on. Just can't do it. When does it stop? Here's my first indicator, 10-year Treasury. The yield of the 10-year Treasury is a good indicator when it's stopping. Now it's at 4.6% right now. If it went, in my judgment, that's my judgment, 5.5% to 6.5%, it looks like it's stopping. Now what does stopping involve? It means higher and higher interest rates. And I have a classroom that I made the mistake of saying, I'll treat everybody in here to drinks next Thursday night. That's great. There's not a single person in there. This is 21. They're like, what do you mean drinks? You mean Pepsi? No. We're talking, in other words, they do not know anything about high interest rates. They were born after the year 2000. We've been in this period, we're hear this now. How these high interest rates? Not high interest rates, you haven't seen high interest rates. I mean, go through the 1970s. Oh, we saw in the 70s and 80s, high interest rates. So the point is, right now, interest rates are pretty normal. Now, it doesn't sound like the way the president's saying, hey, you've got to reduce interest rates. You see what Jerome Powell did. He didn't move. I mean, he's saying, well, I'll write it out. He's not going to reduce interest rates, not right now, at least as we talk today. So, housing affordability, record low. And it looks like, again, what's causing this? It's a supply issue. Supply, pure. Some demand, of course, demand is driving the price up, but it's a lack of supply is driving the price up. But look what's going on, sweeping across Florida, on to Georgia, across to Texas, across to Arizona, supply, inventories. So when you bid on a house in Florida, be careful, because there are huge inventories. Huge inventories in Florida and Texas and Arizona. Some, not as much in Georgia, some in Tennessee, Nashville's, you're seeing some inventory buildups there. But you can find those numbers if you wish to look at them. Reventure is a website I recommend. Allow the 2017 tax cuts to expire. Is that going to happen? Well, what happens here, and I would ask you, we spoke in South Dakota last week, and I asked them, hey, do some pulling with Senator Thune. In your case, with your senators, They want to keep us, they want to get rid of the SALT tax deductions. What you work for, your legislature, your governor has worked to reduce income taxes, the income tax rates. And what that's done, of course, is given you more income, net income. But what they want to do, that's New Jersey, New York, California, list is long, Illinois. They want to raise their taxes, reduce their tax burden, and shift it to you. You in Iowa, me in Nebraska, South Dakota, low tax states. We need to keep the tax lid at $10,000 in my judgment. I would even like to see it brought down. Now, I suffer for that, but I don't suffer as much as those in high tax states like Illinois, New Jersey, New York, California, and so on. So again, the SALT tax deductions.
You have housing affordability at record low, meaning that there are no houses. Does that make sense? Sound like that?
What it means is your income relative to the price of the house. Yeah, thank you for that. Yeah, the affordability is not affordable. Okay. Yeah, thank you for that. How would you say that? You can't afford a house right now. My house that I live in, I got called just yesterday. Hey, you want to sell your house on Burt Street? I'm like, no, I live in the house on Burt Street. I mean, this is amazing. And so you say, well, if the inventory is so high, not in Nebraska, not in the Northeast, but we're going to see the inventories increase even here, and I'll tell you the indicator to watch, the Case-Shiller Home Price Index later on. I'll talk about it. Now that's the Buffett indicator. Look at that. Don't need an economist today. It's at record highs. That's the price of the stock, all the stocks in the U.S. relative to the economy, the size of the economy. In other words, the stock market has grown much faster than the economy has grown. How much longer can that go on? Well, Warren Buffett, who knows, by the way, he lives in the same neighborhood I live in, and he's known for living in substandard housing, by the way. And in that fact, I live in a neighborhood, I went to Walmart in my neighborhood, same neighborhood as Buffett, and I asked for running gear as the clerk. And the clerk said, well, what are you running from? And what are you running to? Is it a robbery? I'm like, no. I'm thinking of jogging. It was a foreign concept to him. He thought I was running from a robbery, but that's the neighborhood I live in. This is the biggie. This is the yield on high-risk bonds, risky bonds, corporate bonds, minus the risk on a risk-free bond, U.S. Treasury. Look at that. It just won't move. It's moved up, and you say, well, it has moved. Not enough. In other words, individuals in America are buying corporate bonds. I wouldn't touch them. Not a high-yield corporate. Now, what would I buy? People say, you're buying bonds? Yes, I'm buying 2-year treasuries. Can't lose. 2 years? Whoops. Did we lose something? Oh. Did you do that? Sorry, I guess I've gone too long there. But anyway, you can't lose buying a 2-year treasury. You hold it to maturity, you get your interest, and you get your maturity. You get your coupon, the maturity back. What am I trying to say? You know what I'm talking about. There, you get your bond back, premium, and you get it all back. A 10-year, though, you can lose, because as you know, as the interest rate goes up, the bond price goes down, and if you have to sell it, you lose money. My wife, and just be aware, when she went to this company, and she filled out this questionnaire, how conservative are you? They sent out, Ms. Goss, you're conservative. We'll put you in bonds. I thought that sounds reasonable. Doesn't. They put her in bond funds. And she lost 12% last year. I was in bonds, I made 5%. Why? A bond fund moves up and down with the stock market in many cases. So if you're in bond funds, watch what you're doing. Watch what you're doing. I can't help her out. I certainly can't help anybody else out. But nonetheless, that premium, the gap between the high yield corporate bond and the 10-year treasury, That's how much risk that investors see out there, and they don't see risk. For the life of me, but I am an economist, and that's usually all we see. So we're biased in the opposite direction from investors. So you're getting the negative view here, the pessimist view. And let's look at home prices. Look at this, if you can see this. This is in 2020, right before the pandemic. Okay, the first one is Little Rock, 529. Oklahoma City, 554. 554, Wichita. Omaha, 699. 727, Des Moines, 727 from Des Moines. Sioux Falls, 749. Kansas City, 752. This is the monthly payment on the median priced home. Now this does not include your payment for maintenance. It does not include your tax fees. So you know what it's killing. Our insurance, which is big time increase. And look at Denver at 1561. 1561. Now let's see what happened there. 2024, look at that. The prices, the increases, you can see that. I'm sorry, it's hard to make those numbers out, but you get the idea. It is unbelievable what's going on in the housing market, and you can't help but think. And what's happening is, young people, I'm a baby boomer, young people can't get into houses, they can't afford it. Not when I was in my late 20s, I bought a house. My daughter, she's a little older than that, she can't get in the house. My daughter who lives in Denver, she can't get in the house. She saw Denver, very unaffordable. In fact, I don't know how many of you are in economic development, but I'll give you a little clue. And I've either been a student, I've either was there, I've talked to young guys and gals. Everybody says, let's get these people to stay here. Let's bring them here to Spencer. Let's bring them to Omaha. Get these young men and women. Don't waste your time. Don't waste your time. You've got to if you want to do that, bring the Rocky Mountains closer in. It's good. They'll come to the Rocky Mountains. Obviously, it's crazy. In other words, once they figure out that I want a family, I want to live in where there's less crime. I'll tell you a little story about my daughter. She lives in Denver. I sent her a Christmas card with a check. I sent her a Valentine's card with a check. Neither one of them got there. The postman refuses to deliver in her neighborhood. Yes. And now she wants to move, and she says, I said, where do you want to go, Camille? I want to go back to California. I'm like, what? I said, come to Omaha. That's not cool enough, you know? I mean, come on, enough with the cool. A student of mine graduated, Peter Dude, you may know him. I've outed him now. He graduated, his parents gave him a new Tesla. Pretty well-to-do guy. Anyway, he moves to San Francisco. I thought, Peter, what are you doing? He can't lock it. He doesn't lock his car up at night. He can't. Because if he does, people break into it. So he leaves it open so they go in there, nothing here, out. I mean, that, in my view, young people will accept that. People my age will not accept it. So in terms of economic development, I think we're just fine in Iowa, just fine in Nebraska, South Dakota, North Dakota. They'll come back when they get to be my age or even younger than me. That's what I would argue.
How come we don't have anybody on like in the East Coast and the West Coast, on some sort of the Midwest?
Oh, just because I do present. The question is, why don't I have any cities outside this region? And the answer is because I do presentations in this area. Okay. But to your point, the Northeast is not doing nearly as poorly as we are. Is it? What's going on?
It's telling you need to switch slides for time.
Oh, I'm sorry. There's the growth. Is it really? It's not. Okay. And federal spending as percent of GDP. Now, Mr. Musk has taken a real hit, of course. But as Jacob, when he introduced me, I was with the CBO. I was with the U.S. Navy. I was with NASA. I was with the military, post office. I've been there, the energy department. Maybe I just know a little bit too much about the government. So I'm a little suspicious when people are criticizing Musk. We need to see some cuts. Now, as I said, I'm a veteran. I'll give you, we all have to share in the pain. I'm sorry, there's pain. I'll share in the pain. Cut down, let's close the veterans hospitals. Now you say, you can't do that. Yes, you can. Give us a chip, little voucher. We go to the place we want to go to. How about cutting the yearly adjustment for Social Security? That can be done. How about raising the retirement age? Now that's a little tougher there. But nonetheless, we all have to share in this. My 7-year-old grandson, he's going to share in it big time when he gets to be our age. So we all have to pitch in. The idea that somehow we can all get by without it is fantasy. We have to pitch in, do something about the overspending, and it is overspending. It absolutely is overspending by the federal government. Even NASA, and I was with NASA for a little while, I have great respect for NASA. It's the best agency I was with. But even there's overspending. Now, if you can see that, okay, that's what I've graphed there is Medicare, the white. The blue is Social Security. And the yellow is Medicaid. Now, that one's sloped upward because of some cost for those who immigrants. This is a lot of cost there, and that was New York. We've got to see that in California. That's going to be coming down, I think. Here's the other one. That's the one that distresses me. That's interest expense. Look at that. I mean, is that going to stop? No. It's going to go even higher. What happened with Secretary of Treasury Yellen? What did she do in her last year of office? She borrowed short. She borrowed short. Well, so what? It means those notes have got to be renewed at higher interest rates. So we've got to do that. So I'm really concerned about this interest expense, and as it chokes off other spending, which is good. There's a lot of good spending that the federal government does, but we need to examine it. Let's put it that way. Now look at any debt money. Look at that. That's your debt, my debt. Look at that. Since we had, look at this. We had the Trump stimulus package. We had the Biden stimulus package. We had the Biden infrastructure bill. We had the Biden CHIPS Act. The CHIPS Act. $258 billion to reshore manufacturing. How's that going for us? Not well. We've lost almost 100,000 manufacturing jobs over the last year. That's how well it's doing. Reshoring is not working. Look at this. That's the money supply. It's flatlining. So why is the inflation going up? Well, there's another little term called velocity. That's increasing, pushing up inflation. So we're seeing that. I want to turn to this one. This is very arcane, but I'll invite you to go to Google and type in Federal Reserve balance sheet. Just put it in there, it'll come up with this exact graph right there. Tells you, and this is new. New in 2008, Ben Bernanke, an economist at Princeton, said we need to start this new program whereby we buy bonds, start buying bonds to lower interest rates. They bought, and they bought, and they bought, and they bought, and here's the pandemic, $3.8 trillion. Now we're at $6.8 trillion. It's called quantitative easing when they're going up. It's called quantitative tightening when they're going down. That's what we're seeing right now, the tightening. But what you see a little blip there? You can see that blip. You say, what the heck is that? You remember Silicon Valley Bank, Signature Bank, First Republic? The Federal Reserve, and Janet Yellen, Treasury Department, bailed out those three banks. So what does this tell you? It tells you if we go through another calamity, that's too strong a word, they're going to do it again. Now what Janet Yellen said, too big to fail. Too big to fail. And she's telling small banks and community banks that we thrive on, that we survey, that you're too small to succeed. What happened last time? Last time, Iowa lost 40% of its banks, 2008 and 9 and 10. Now, that doesn't mean they failed. It meant they were merged, buyouts, and so on, which you had this consolidation. Does Jamie Dimon, does he know what Iowa needs? I would say no, but nonetheless, you see that right there, and that's almost a guarantee. The next time J.P. Morgan or first, the large banks, Wells Fargo, the larger banks get in trouble, they'll bail them out. But what about some of the banks in the communities? I don't think so. What they want there, Janet Yellen even said, we want J.P. Morgan to buy that bank. That's not the best interest of agriculture. It's not the best interest of your communities. We need community banks. We need them. Here, look at that. That's the interest rate right there. That's the one everybody talks about. But what's happened is, if you watch the press conferences, and I know you got better things to do than watch a press conference at Jerome Powell, but what he does, he talks about over here. It's like a magician. He's talking about the funds rate, and over here, the real action's on that other one. That's the balance sheet. That's where the action's going to be. So what's going to happen, you add 3% to that last number, and that's the prime interest rate. Prime interest rate now is 7.5%. So when this goes, and the market had been expecting this to come down even more, that was a fantasy. When's the next meeting of the Fed? The 18th and 19th of March. Will there be a cut then? I don't think so. We're more likely to see a rate increase. Now that increases your operating loans, the interest rate there up. Now it doesn't necessarily mean your mortgage rate's up, but the mortgage rates, what happened on the 18th of September? They cut interest rates by 50 basis points, they being the Federal Reserve. What happened to the bond yields the next day? Up. What happened to mortgage rates? Up. Now what does that tell you? It tells you that inflation, investors globally say that's a problem. And it is a problem. It was a problem. It remains a problem. Again, now I'm not saying this is forever, but we need some relief here. Where does the relief come from? It comes from cutting government spending. We can do it. We can do it, but we've got to do it. Okay, here we go with year-over-year. Look at this. If you can see that, that's the price of gold. Now, that should have, as I said, this is a dated presentation. I should have put in the last numbers. Gold's moving almost $3,000. The expectation is $3,056. And then we're going to see perhaps some reversal. Now, not a strong reversal, some pullbacks. Those of us who own gold would probably sell gold, but we're going to jump back in. Gold is influenced by two things: inflation, which is, as I said, upward, as I think, but also global insecurity, volatility. When you see that, you turn to gold. Now, Bitcoin is one of the others, but that's a Bitcoin, a safe haven buy? I don't know. Not for me. I don't know. Right there, that's silver. Look at natural gas. I mean, can you believe Justin Trudeau? I mean, I worked on the Keystone XL pipeline project. I did, and I worked for the Canadian government, okay? Justin Trudeau, well, he didn't kill it. Biden killed it first week in office. First week in office, he killed the Keystone XL pipeline coming down from Canada. Well, look at what's in natural gas prices. You can drill in Canada for $2 to $3 per million BTUs. You can transport it to Europe and sell it for $10 to $13, $12 to $13. So the point is, Canada is a juggernaut in terms of natural gas, and we are as well. Turn, as the president says, drill, baby, drill. They need to drill. Now, Justin Trudeau is out, as you know, and that's going to be good for energy prices, going to be good for energy production, and it's certainly going to be good for agriculture. I mean, agriculture, big users of natural gas, fertilizer. We see that. That's, well, I should say good for, and good in the sense that you're going to see higher prices. Now, obviously, your cost of production is not going to be good, but in terms of what we're seeing for the growth in GDP, I take that back. We're going to see higher prices in natural gas, and it does reflect your cost, so we'll see some negatives there. But nonetheless, whoops, Or is it gonna come back? Oh, okay. Year-over-year, all commodities, farm commodities, the ETF, Exchange Traded Fund, the MOVE. If you want a little bit of agriculture, buy the MOVE. Buy MOVE, it's an exchange traded fund. I bought it right there. You see it up there at 70, that high point, that's when I bought it. I bought it right there, and I still own it right down there. And I'm not selling, because I really believe the long-term outlook for agriculture is darn good. If we'll let, what was it, they used to say, let the big dog hunt. That's what we need. I mean, the heavy burden of government is pulling back on agriculture. I mean, look at the equipment out here. It's unbelievable. What we have in America, I mean, the Brazilians, they're not going to, we'll outcompete the Brazilians, the Argentines, the Chinese. So we're there. So again, we need free air trade. Not necessarily free trade, but let's have that. Let's have that. We need to see that. Sorry about that, I guess. We're just gonna. Okay, here's another one. As I said, keep an eye on the 10-year treasury. Okay. Okay, is it shorting out? Sorry about that. I'll lay that on Blake there. It's his PC. Blake, no, I will share the burden there. Look at the 10-year treasury there in yellow and the 30-year mortgage right there in white. You don't need to be an economist to see when the 10-year treasury tunes up, the 30-year mortgage rate tunes up. So keep an eye, as I said, in my view, that's the best indicator for you to watch for what's going on in inflation, what's going on in the value of the dollar, what's going on potentially in international trade. And again, there's a lot of mitigating factors in that. But I better move on here. Here's our survey. This is manufacturing, U.S. manufacturing, below growth neutral. 50 is growth neutral. U.S. manufacturing's lost 93,000 jobs over the last year. And here is Iowa manufacturing. Mid-America, we call it. Nebraska, also below 50. So you see, we've had a tough year of it in manufacturing in this part of the country, but the U.S. as well. And now here, unfortunately, is ag. Our rural Main Street makers, 42.3. Our survey results will come out Thursday. I don't have those in hand right now, but I would say it'll be up. I think we're going to move, we're turning around, of course. You see what's going on in corn and soybean and wheat to a lesser degree. Prices are at least moving in the right direction. Of course, you're seeing livestock prices, at least in terms of beef, moving lower, pork moving a bit higher. And that's probably going to be a good thing in terms of pork going forward. And Iowa, don't need to tell you, it's also poultry as well. Poultry in terms of eggs, egg production, I mean, $7 a dozen? Gosh, that's good for you. You got the indicators for you to watch going forward. Employment report on March the 7th. That's coming out, that number, as long as it's between 100 and 200,000, no change much. 100 to 2,000. Gets above 200, say 300,000, you got a rate hike coming. If it gets below 100,000, you will have a rate cut coming. Again, the next meeting of the Fed after that is March the 18th and 19th. Federal Reserve actions on the balance sheet, if they continue to do what's called quantitative tightening, they're allowing bonds to mature. That's what they're allowing. That takes money out of the supply, and that's helpful in terms of inflation. It's not helpful in terms of growth. So that's very critical to watch what goes on there. The FOMC meeting, the Open Market Committee meeting on the 18th and 19th, I don't think they're going to do anything right now. All they'll do is probably scare all of us, saying, hey, we're going to do this or that, but they don't know. I mean, the problem is it's easy to criticize them. I mean, I'm sitting here as if I would have done anything different, But they're sort of looking, they're saying we're data driven. Well, the data's old. All the data they're looking, almost all the data they're looking at is old. So I'm not sure that's a good strategy. So anyway, Case-Shiller Home Price Index, March 25th. That's the last Tuesday in March. That price index is an old, it's probably, that's December's number, I believe. I believe it's December. It's moving down, not much, but down. And that's a good thing to see the housing market cool off a bit. We need to see some cooling. 1% decline, 2% decline, that's good. 3% decline, even better. 10%, it's getting a little scary there. We don't want to see, I don't want to see that. 10-year Treasury and that high yield corporate. Look at that gap. It's so, and I know it sounds complex. It's not complex at all. Just go to the St. Louis Federal Reserve. They'll give you those rates. They'll give them to you. Just take the difference. That's the important thing. Is the difference between those two rates tells you how much risk investors see out there. Right now, the investors they take all the bad news and say, well, it's not so bad. All the good news, that's great news. I mean, they got to moderate that enthusiasm a bit. We economists want to cool your jets, is what we would say. The ISM and Creighton surveys, first business day of the month. Of course, as I said, our banker survey comes out this Thursday. Statements by members of the FOMC, BRICS meetings. I mean, BRICS, that's so arcane, but the president talks about it, so it's not too arcane. The meeting of the Brazil, Russia, India, China, and South Africa. They want to they want to kick the dollar out of its reserve status. Your dollars, my dollars, are the reserve currency of the world. It's not going to happen. I mean, you hear people, oh, we're going to lose our status. Not going to happen. Not from those. What they want is a digital currency backed by gold. Do you think Brazil, Russia, India, China, and South Africa can come to an agreement? I don't think so. Don't think so. Nonetheless, it just shows you the direction that we're headed. And if we did lose our status, what would that mean to you? Higher interest rates. Higher interest rates, because what's happening now. And one of the other factors I didn't talk about in my first set of slides, why is the U.S. stock market doing like this? Because of international money flowing in. They can't find a better place to put their money. You're going to put it in Venezuela? I don't think so. You're going to put it the best place. We are the healthiest patient in the ICU unit. Right now, we have the cleanest shirt and dirty laundry. The healthiest horse in the glue factory. Whatever. That's who we are, and we are the best right now. And the president was right. President Biden, that is. He was right, talked about the good economy, but it was not as good as he thought. Why? I mean, remember Carville? Remember he said, it's the economy, stupid. That's what he told Clinton. Well, it was. And Harris got kicked out because it was the economy, stupid. 80% of Americans are not doing very well. I would venture to say most of us have done okay. We have assets. You have assets. I have assets. The guys and gals in my class and those that graduated in the last 10 years don't have those assets. They have not done as well as we have. And it showed up in the elections. They voted, kick him out, kick her out, Biden out, and Trump in. That's part of it. So I think the last slide we have, if you want to get my newsletter, our newsletter, it's free and well worth the price. And if you find you're disappointed with it, we'll double the subscription fee back to you. You can send me an email at ernieg@creighton.edu. And there's no advertising. We don't turn your email address over to anybody. I'm not that sophisticated. Oh, we got 12 minutes for questions. Oh, I don't know if I have 12 minutes of answers. No. Hopefully I do. Questions, and I'll try to respond as best I can, or statements if you wish to make a statement. Yes?
I don't know if this is anything you can answer, but what do you think about the government getting into our Social Security account?
What do I think about the government getting into our social security accounts? Not good. But I think they need to get in there in the sense of making sure it's not going to be insolvent in year 2032. When I was with the Congressional Budget Office, the CEO was always too positive. And I was in the macro division. But getting data, no. I mean, do I want them contacting me and saying, well, Mr. Goss, I understand, here's your social security number. No, I don't want that, of course. And that is a real, but I think the news media maybe, I don't know, but maybe playing a little loose with what Elon Musk is doing. I don't know. But he does seem awfully happy, though. I don't know. Yes?
Well, what about land prices? I mean, how much are we going to back up here?
Yes, land prices, farmland prices continue to expand, even though farm income is not good. Farm income for 2023 and 24 down. 25, though, I would argue is going to be better, well, it has to be better than 24, but you're going to see, I think you're going to see grain doing much better. I don't think beef could do any better. You know, you're probably, it's called regression to the mean. In other words, when something grows like this, like beef prices, it moves to the mean right here. That's what we'll see this year. I'm fairly confident of that. Pork prices, on the other hand, you're likely to see those continue. You know, but a lot of that depends. I mean, this is unbelievable to me when I look at the numbers every month. What percentage of our agricultural output you think goes to Mexico? I'll tell you, the average for the 10 states, 47%. And the rest of Iowa's even higher. So Claudia Sheinbaum, president of Mexico, she's got some hands in her hand. She's got a deck of cards. She's got some cards in her own hand that she's been dealt. And she might get tough. And if she gets tough, I'm concerned for us in this part of the country because, again, I think this year is going to be good for grain compared to 24 and compared to 23, but not if she slaps on tariffs on our agricultural exports to Mexico. Now, Mexico had already said GMO corn out. That was never going to happen. I mean, GMO corn, get real. Were they going to not allow our corn into their market? They were. But when we erect tariffs, that's my concern there. Other questions? Yeah. Oh, yes, back in back.
I'll just keep the fun going, Ernie.
Okay.
You said that 2025 is going to be better. We know thanks to the act, and I don't remember what it's called, something Relief Act, January 7th, is raising direct payments to farmers from $9.3 billion to $43 billion, which is a 435% increase on subsidies to farmers.
Right.
What will we pay for that?
Yes, and you know, when I did it, when Monique and I were in South Dakota presenting, I had a lot of farmers that came up. They were not happy with that bill, not because it was small, because it was large. They think they'll be paying a price for that assistance. And you know how much per bushel? Not that much per bushel. A lot of it goes to peanut farming in Georgia. And I was a research faculty at Cal State Fresno, Central Valley. A lot of it goes to Central Valley in California as well. So the bottom line, I don't think it's going to be that, it certainly does help in terms of net cash flow. But in terms of overall economy, I don't think it's going to help that much. What we need to see, in my judgment, is a separation of the ag bill. You need to have food stamps separated out. I mean, I know it's how you get bills through Congress, just to put the two together, but they need to be separated out. Because people say, well, look at the size of the farm bill. It's not that large. It's more of the food support for individuals and families out there. I'm not opposed to that necessarily. I'm opposed to how big it is, but nonetheless. And also 1-year farm bill. How many 1 years can you have? We need a 5-year farm bill. And your congressmen, your senators are pulling for that, but It doesn't, and now we have, of course, a good ally in the Senate anyway. They have the Senate, majority of the leader of the Senate from South Dakota. But I don't, how much is that going to help? I don't know. But to your point, I don't think it's going to, that's about all I can tell you about that deal. And the point here is, in the end, you pay for it yourself. I mean, you're going to pay for the bill. I mean, it's, in other words, higher interest rates, because obviously it adds to the deficit. And then, you know, $1 billion here and $1 billion there is, what is it? Your neighbor across the way in Illinois said $1 billion here and $1 billion there. Pretty soon you're talking about some money. That's what we're talking about. Real money. So that's about all I can say about that farm bill, because we hadn't seen it in terms of our surveys. Not there yet. Not there yet. In terms of surveys of banks. These are bank CEOs and chief loan officers of banks in rural areas of 10 states. Average community size is 1,300. So I think they have a pretty good feel for agriculture. Now, one would argue, but farmland prices, they're not growing, they're declining. Our bankers expect, now this is across 10 states now, 10 states. They expect the decline of about 3% this year in farmland prices. Now, when we asked the average rental price for farmland last month across the region, now 10 states, and it's stronger here. Northern Iowa is the strongest farmland prices that we record. It was $278 per acre per year. Now that's probably below the average in this part of Iowa. And it's certainly well above what you see in South Dakota, North Dakota, Kansas, about average for Nebraska probably. Missouri, probably about average in Missouri. So that's what we're seeing. So again, we all pay for it. I mean, my daughter, she couldn't, back in, remember the pandemic, she got her payment. Look at this, I got $2,000, I don't know how much she got. Where's your check? Well, I didn't get one. And most of you probably didn't either. So the point is, I mean, buying votes is just, it's something that it's so frustrating. Everybody sent the message to Washington to do something, and now, I mean, I'm not necessarily validating what they're doing, but they're doing something. It's now saying, we can't do that. What can you do? What can we do? And I've offered shut down the VA hospitals and give us vouchers, raise the retirement age for Social Security, cut the yearly Social Security boost below, the inflation adjustment. Cut that one. There are other, make students pay back those loans. How about that? That's a strange one. Yeah. I mean, we need that. I mean, it's the most amazing thing. But, I mean, I'm surprised the president of our university, we're at Jesuit University, even there they do have a good handle on money, even though they do take vows of poverty, chastity, and obedience, none of which I'm keen on, by the way, all of which I indulge in. But anyway, I'm surprised he doesn't call me and say, well, that new student aid bill, how much do you think we could increase our tuition by? I mean, that's exactly, it goes in my pocket. It goes in my pocket. It does find its way in there. $450 billion student aid there. They need to pay it back. I don't care if you work for a nonprofit. I don't care if you work for Creighton University. I don't care. You borrow it, you pay it back. That's not how it's operated. It's sort of like, well, you're doing a good deed. No, you borrow. And the problem is our failure. Universities across America are failing to educate. What's the problem is we don't deliver an education that's of value. They're saying, well, I'm not paying back that. I went to this school and I'm ill-educated. My daughter went to a school that went bankrupt, went out of business. Now, is that her fault? Perhaps. Perhaps. Maybe she should have done a little more investigation. It was California school, by the way. And I'm sorry, but I'm not, California's not one of my favorite states. Yes, sir.
Back in the student loans, I mean, I realize that's crazy. One thing about it that really sticks in my throat is that you can't declare bankruptcy on student loans. These corporations they do that all the time. They take risks, they take bankruptcy, they take more risks, they change their titles, and anytime they make a mistake, they're fine. Students, on the other hand, not that they shouldn't pay back, but once in a while, life comes along and hands you a tough card. And, I don't see why bankruptcy, why was that not included? I mean, why is that not treated the same with student loans?
Oh, I don't argue against that. I mean, I do see, but the problem is the debt's not created by corporations. Corporations are held more responsible for their debts than students are.
I'd like to see that.
I can promise you. I can promise you it is. I mean, President Obama, he took it, what was a good program, well, a reasonably good program. It was in the private sector. He took it over to the public sector, and it's been lousy. It was lousy before, but it got more lousy. Imagine that. Yeah, I mean, but it is, if corporations borrow, pay it back. Students borrow, pay it back. Bankruptcy is still an option. As you say, it's not an option there. Yes, you're correct.
Did you see those oil fields out there that they don't seal? Those big companies drill those oil wells, run most of them out, and they sell them when they're to somebody at the very end, and then at closing, nobody ever closed them. And the methane you're talking about coming out of those, they've been raising hell about us. It's great with our cattle raised methane, and they have what 750,000 oil wells that haven't been closed, and sitting there, and the methane's coming out of them and going into the groundwater, and we don't do a damn thing about it. And the oil companies, they just bail on them. We're not closing those.
Well, that's a failure of regulatory bodies, yes. That's correct. I agree, but I don't, I know you're not saying this, but right now I hear this, well, if you happen to be wealthy or you happen to be earning high income, then you're doing something wrong. I don't agree with that. I think that America has always saluted winners, and there are people, yes.
We need competition in there. When the oil companies and these big people are running the government, it used to be the government was doing bureaucracy. Now they have people,
Oh, yeah.
they are the government.
Oh, yeah, there's no question that.
Your time when you say
Oh,
that. They
sorry.
are.
Okay, sorry. Well, I agree with you that there's just, that big business is in collaboration with big government. There's no doubt about it.
They have us competing
Yeah.
down here.
Yeah.
And we do.
Yeah, I would argue for small businesses. Small businesses. Are you in favor of small businesses?
Well, yeah.
Okay.
But I mean, you have to have a way to stay in business if you're a small business,
Right.
And they're disallowing.
But Jamie Dimon, who's head of J.P. Morgan, he's a politician. When you get to be that level, he's a politician.
They aren't even a bank. They gamble.
You're right. We do need to.
High risk investment.
Yeah, but I wouldn't label. I think the big businesses, there is a collaboration. It's costly for taxpayers. But I say small business in America, we need to support smaller business, medium-sized businesses a lot. Yes.
We need to find some representation.
Oh, Blake's coming up. Hey, Blake, thanks. Here you go. Sorry. Okay, stay on schedule. Thanks for having me tonight.
Goss, we appreciate you taking your time with us today. A reminder, we have over 80 vendors in there, anxious to see you all, and we'll get set for our next presentation in an hour at 2:30. But yeah, go stretch your legs a little bit. We look forward to seeing you back here at 2:30. Thank you for supporting the Northwest Iowa Ag Hub.